third lecture on money and banking. I'm from Thankan University, and in the last two lectures, we have discussed about banking, money, money's evolution over the period of time. We have also discussed about various stages which are involved in the evolution of money. We have already discussed about the various functions of banks, the acceptance of deposits and lending of money. We have discussed how do banks earn. I hope all these concepts are very clear with you all. Today, we have abundance of material to study about the demand and supply of money. We'll be studying the various factors which are involved or which manipulate the demand and supply of money in the economy. Let us discuss the objectives of today's lecture. The objectives are as follows, that is, to understand the demand for money, to understand the concept of supply of money, to study the theory of liquidity preference, and to understand the concept of money multiplier. The following are the contents of the lecture. The first is demand for money. Next, motives of demand. Then, the supply of money. Next is the measure of money supply. Liquidity preference theory. Last but not the least is money multiplier. So without delaying further, let us start with the very first topic, that is demand for money. The demand for money refers to the total amount of money individuals and businesses wish to hold at any given point of time. This demand is influenced by several factors which can be categorized into three main motives for holding money. Let me repeat, the demand of money is influenced by several factors which can be categorized into three main motives for holding money. The three main motives for holding money are transaction motives, precautionary motive, and speculative motive. Let us discuss briefly about these three motives first. First is transactions motive. This motive arises from the need to carry out transactions in the economy. Individuals and businesses hold money to facilitate their day-to-day transactions such as buying goods and services, paying bills, and conducting regular business operations. The amount of money demanded for transaction purposes depends on the level and frequency of transactions. Factors like income levels, the frequency of transactions, and the structure of the economy, like cash dependent or digital transactions, influence the demand for money for this motive. I hope I am clear that transaction motives arises from the need to carry out transactions in the economy. Individuals and business hold this money to facilitate their day-to-day transactions. Day-to-day transactions involved in buying and selling of goods and services, receiving and paying the bills, and conducting regular business operations. Now, let us move further, that is precautionary motive. Money is also held for precautionary reasons, that is to meet unexpected expenditure or emergencies. This motive reflects the desire to have a buffer or safety net in case of unforeseen circumstances like medical emergencies, sudden repairs, or job loss. The amount of money demanded for precautionary purposes depends on the factors like uncertainty in income, economic conditions, and personal financial ability. Higher uncertainty typically leads to a greater demand for money as a precautionary measure. So, the money that is held for precautionary reasons, that is to meet the unexpected expenditure or emergencies. The precautionary motive reflects the desire to have a buffer or safety net in case of unforeseen circumstances like medical emergencies or sudden expenses that occur due to any unforeseen event. The next motive is speculative motive. The speculative motive for holding money is related to the desire to take advantage of unexpected changes in the value of financial assets. I repeat, it is related to the desire to take advantage of expected changes in the value of financial assets, including money itself. This motive suggests that individuals and businesses may hold money if they anticipate that the value of other assets such as stocks, bonds, or real estate will decrease in the near future. I repeat, this motive suggests that individuals and businesses may hold money if they anticipate that the value of other assets such as stocks, bond, or real estate will decrease in the near future. Holding money in such cases allows them to be ready to buy these assets at lower prices later on. Interest rates, expected returns on the other assets, and perceptions about future assets prices influence the demand for money for speculative purposes. I hope I'm clear with all the three motives, that is speculative motive, precautionary motive, and transactions motive. Each of these motives interact with various economic variables. For example, higher interest rates might reduce the demand for money as people opt for interest-bearing assets instead. Changing in income levels can also affect the amount of money needed for transactions. While economic certainty can increase the demand for money for precautionary reasons. Hence, to conclude, I would say that the demand for money is shaped by the transactions, precautionary, and speculative motives, each influenced by different economic conditions and individual preferences. Understanding these motives help economists and policymakers analyze and predict changes in the overall demand for money in the economy. Let us study about these three main motives in detail. The three main motives are named as transactions motives, precautionary motives, and speculative motives. Let us first study about transactions motive in detail. The transaction motive for holding money is based on the need to conduct Day-to-day transactions in the economy. The day-to-day transactions are like paying and receiving bills and to facilitate the operating activities of a business. This can also include purchasing goods and services and meeting other routine financial obligations. Money, which is held for this purpose, facilitates the smooth functioning of economic activities without the need for immediate conversion of other assets into money. I repeat, money held for this purpose facilitates the smooth functioning of economic activities without the need for immediate conversion of other assets into money. The factors which influence the transactions motive are income levels, transaction costs, frequency of transactions, and technological advances. Let us discuss these four factors. First, income level. Higher income levels generally lead to higher transaction volumes, thus increasing the demand for money. If the income levels are low, then obviously the number of transactions or the volume of transactions would also be low, thereby decreasing the demand for money. So, higher income levels generally lead to higher transaction volumes, thus increasing the demand for money. Second is transaction costs. Costs associated with converting non-monetary assets into monetary, that is liquidity cost, affects the demand for money. I repeat, costs associated with converting non-monetary assets into money affect the demand for money. Higher transactions costs may increase the amount of money people prefer to hold. That means higher transactions cost will increase the amount of money people prefer to hold, because in order to facilitate higher transactions, a greater amount of money is to be held by the people. Third is frequency of transactions. Economies with frequent transactions require more money in circulation to facilitate these transactions efficiently. That means more amount of money is needed to be in circulation to have these successful and the efficient transactions. The last is technological advances. Advancements in the financial technology, that is fintech and digital payment systems, can influence demand for physical cash versus digital money. That means fintech and digital payment systems have directly or indirectly influenced the demand for physical cash as well as digital money. People have inclined more towards using digital money rather than keeping physical cash with them. So, we have discussed about the transactions motive in detail and the factors that influence the transactions motive. The factors include income levels, transaction costs, frequency of transactions, and technological advances. Now, let us discuss about the second motive, that is precautionary motive. The precautionary motive for holding money arises from the desires to have a buffer or safety net against unexpected events or emergencies. That is, it is the money which is held to have a buffer or safety net against unexpected events. Individuals and businesses hold money to ensure that they can cover unforeseen expenses without resorting to borrowing or selling their assets under unfavorable conditions. That means these motives are basically held to keep the businesses and individuals safe from any unforeseen loss or expenses which may lead to borrowing or selling other assets in the unfavorable conditions. There are various factors which influence the precautionary motives. The very first factor which influence the precautionary motive is income stability. Individuals with unstable or irregular income may hold more money as a precautionary measure because they are more vulnerable to have unforeseen circumstances or to borrow or to sell any other assets in the unfavorable conditions. So, the individuals whose income is irregular or unstable are more likely to have money or hold money as a precautionary measure. Second is uncertainty. Uncertainty is another factor which influence the precautionary motive. Economic and personal uncertainty such as job instability or health issues increases the demand for precautionary savings because they know or somewhere they have imagined themselves from suffering in the future due to conditions like any kind of physical or mental illness or job security. So, they tend to hold more amount as precautionary motive. The third factor which influences the precautionary motive is financial market conditions. Access to credit and borrowing costs can influence the need for precautionary savings. Tight credit conditions may increase the demand for money. That means the demand for money is directly proportional to the credit conditions prevailing in the economy. Tight credit conditions may increase the demand for money, whereas loose credit creations may decrease the demand for money. I hope precautionary measure or motive or transactional motives is really clear with you all. Now let us start with the third motive, that is speculative motive. The speculative motive for holding money is driven by the expectations of future changes in asset prices, that is including money also. Individuals and businesses may hold money rather than other assets if they expect the value of those assets to decline in future, enabling them to purchase them at lower prices later on. That means individuals and business may not invest anything or may not buy the assets whose value is expected to be declined in the near future. Rather, they would prefer to have cash because they know that they would be able to buy other assets in the future at lower costs. There are various factors that influence speculative motive. The first factor is expected returns on assets. High expected returns on alternative assets like stocks or bonds relative to holding money can reduce the demand for money for speculation purposes. That means if any individual or business would expect higher returns on alternative assets like stocks or bonds, the demand for money would be decreased. That is, for the speculative purposes, the demand for money would be reduced. The second factor which influences the demand for speculative motive is interest rates. Change in the interest rates influence the opportunity of holding money versus earning interest on alternative investments. That means if the interest on investments is higher, there are less chances for the people or individuals or any business to hold money because they would invest the money to have higher rates of interest. The third factor which influences the speculative motive is inflation expectations. Anticipated inflation can affect the attractiveness of holding money because inflation erodes the purchasing power of cash over time. That means anticipated inflation can affect the holding money because inflation can erode the purchasing power of cash over time. I hope I'm clear with all the three motives. The three motives were transactions motive, precautionary motive, and speculative motive. Let us study another topic, that is interaction of factors and motives. These motives are not mutually exclusive and often interact in complex ways. That is, there is a complex interaction of factors and motives. First is economic conditions. Changes in the economic conditions like recessions or economic booms can affect all three motives. For example, during economic downturns, precautionary savings may increase due to heightened uncertainty, while transactions may decrease because when the conditions are unstable and there comes recession and economic booms, there comes a point of time when people would increase their precautionary savings to save themselves from the uncertain events, while they would decrease the number of transactions to have more money in their precautionary savings. The next is policy impacts. Monetary policy decisions such as changes in interest rates or regulations affecting financial markets can influence the demand for money across all three motives. That means we can say that monetary policy has a greater influence on the money which is there, which circulates across all the three motives. The last is technological advancement. The rise of digital payments and cryptocurrencies can reshape the demand for money. That means the rise in the digital payments or cryptocurrencies has changed or reshaped the demand for money, particularly for transactions, by offering alternative means for conducting transactions. To conclude, I would say that understanding the demand for money through these motives helps economists and policymakers analyze how changes in economic variables and individual behavior impact overall economic stability and growth. By monitoring these motives, policymakers can make informed decisions regarding monetary policy, financial regulation, and economic stimulus. It would help to measure and to maintain price stability. It would also promote economic growth and will also ensure financial resilience. I hope I am clear with all the three motives and the interaction of factors between motives. Then let us now understand the concept for demand of money and supply of money. There is the importance of understanding demand for money because it helps in economic stability and growth. It also helps in the policy implication, financial resilience, and consumer behavior. Now, let's discuss some important question and answers related to the three motives and the demand for money we have studied. The first question is, how do interest rates influence the demand for money? The answer to this question is that interest rates affect the demand for money in various ways. That is, higher interest rates may increase the opportunity cost of holding money because individuals and businesses can earn more money by investing in interest-bearing assets. That means interest-bearing assets may lead to higher incomes where they give high interest volume. Therefore, higher interest rates typically reduce the demand for money, especially for speculative and precautionary motives, because people prefer to invest in assets that would yield higher returns. Conversely, lower interest rates can stimulate the demand for money, particularly for transactions and precautionary purposes, because the cost of holding money decreases relatively to other investments. So yes, interest rates do influence the demand for money. The next question is, what role do inflation expectations play in the demand for money? The answer is inflation expectations influence the demand for money, particularly for the speculative motive, not for the transactional as well as for the precautionary motive. If the individuals and businesses anticipate higher future inflation, they may hold less money because money loses purchasing power over time. This expectation encourages spending or investing in assets that can hedge against inflation. That means if an individual or a business would anticipate higher future inflation, it would lead to lower holding of money or less holding capacity because money loses purchasing power. So, in order to have fulfill their expectations, they would start spending or expecting or investing in assets that would hedge against inflation. On the other hand, if inflation expectations are low, that means there are less chances of inflation, the demand for money may increase as people feel more confident in its purchasing power, thus reducing the urgency to spend or invest quickly. The next question is, how does technological advancement impact the transactions motive for holding money? The answer says technological advancements, especially in payment systems and banking, have transformed the transactions motive for holding money. With the rise of electronic payments, including mobile wallets and online banking, individuals and businesses can conduct transactions more efficiently without relying heavily on physical cash. That means electronic payments like mobile wallets and banking services which could be preferred over physical use of POS have completely eliminated the reliance on physical cash. The shift reduces the need to hold large amounts of cash for daily transactions, potentially lowering the demand for money for transactional purposes in the economies where digital payment infrastructure is well developed. That means a well-developed digital payment infrastructure may reduce the dependence on physical cash. The next question is, explain how economic uncertainty influence the precautionary motive for holding money. The answer to this question is, economic uncertainty such as concern about job security, business downturns, or financial market volatility increases the precautionary motive for holding money. During uncertain times, individuals and businesses tend to hold more money as a buffer against potential income shocks or unexpected expenses. This precautionary saving behavior provides a sense of financial security and liquidity during periods of instability, reducing reliance on credit and ensuring the ability to meet financial obligations without resorting to selling assets at unfavorable price. The last question is, what are some policy implications of understanding the demand for money? Understanding the demand for money, the answer to this question is, understanding the demand for money helps the policymakers formulate effective monetary policies and financial regulations. Central banks, for instance, monitor changes in the demand for money to adjust interest rates accordingly, influencing economic activities and inflation levels. Financial regulators consider motives such as speculative behavior and technological advancements when designing policies to promote financial stability and consumer protection. By aligning policies with the drivers of money demand, authorities can better manage economic risks and support sustainable growth. I hope these question answers have made the topics more clear and understood and easy to understand. Now, let us start with another topic, that is definition of money supply. We have already discussed about the demand for money. It is the time to discuss about the money supply. The money supply refers to the total stock of money or the monetary assets that are circulating in an economy at a given point of time. It includes all forms of money that are widely accepted as a medium of exchange, unit of account, and store of value. While the term money supply might imply a flow of money over time, it is actually a stock concept. That means it represents the quantity of money available in the economy at a specific moment rather than the rate at which money is exchanged or used in transactions. The components of money supply can be categorized into different aggregates based on their liquidity and accessibility. First is M1. This includes most liquid forms of money that are immediately spendable. It typically comprises currency, that is physical notes and coins in circulation, and demand deposits held by individuals and businesses. That means M1 is the most liquid form of money which is immediately spendable. It particularly includes physical notes and coins and demand deposits held by individuals and businesses. M2. M2 is a broader measure that includes M1 plus saving deposits, money market mutual funds, and small time deposits like certificates of deposits or CDs. M2 reflects money that is less liquid than M1 but can still be readily converted into cash or used for spending. That means M2 includes M1 as well as saving deposits, money market mutual funds, and small time deposits. Then M3, an even broader measure than M2. M3 is broader than M1 and M2 both. It includes M2 plus large time deposits, institutional money market funds, and other large liquid assets. M3 provides a more comprehensive view of the total money supply, including larger and less liquid financial assets. Let us talk about the importance of money supply. Money supply is really important. It is divided into categories. The first is monetary policy tool. Central banks and monetary authorities use the money supply as a key tool in implementing monetary policy by influencing the availability of money as well as credit in the economy. Central banks can regulate economic activity, control inflation, and stabilize financial markets. That means if the availability of money and credit in the economy can be influenced, there can be the regulation over inflation and the financial markets would be stable. The second point of importance of money supply is indicator of economic activity. Changes in the money supply can indicate shifts in the economic activity and consumer spending. That means money supply can indicate or can influence the shift in the economic activity and consumer spending as well. An increase in the money supply may stimulate economic growth by boosting spending and investment, while a decrease might stimulate or signal of a tightening of credit conditions and potential economic slowdown. That means money supply can make shifts in the economic activity and consumer spending. If there is an increase in the supply of money, there can be stimulate economic growth by boosting spending and investment. But if there is a decrease, it might be a signal of tightening of credit conditions and potential economic slowdown. The third point of importance of money supply is inflationary pressure. The money supply is closely monitored for its impact on inflation. The growth in the money supply relative to the growth of goods and services in the economy can lead to inflationary pressure, as more money chases a relative stable or limited supply of goods and services. Then the next is monetary base. The monetary base also have a high-powered money or narrow money refers to the total amount of currency, that is notes and coins, in circulation plus the reserves that commercial banks hold in their accounts at the central bank. The monetary base serves as the foundation for money supply because it directly affects the ability of commercial banks to create new money through lending and investment. Changing in the monetary base or the changes that are observed in the monetary base controlled by central banks through open market operations and reserve requirements. Reserve requirements have a multiplier effect on the broader money supply. Next is money multiplier. Money multiplier is a concept that reflects the ratio of the increase in the money supply to the increase in the monetary base. It represents the extent to which an initial deposit can lead to a greater final increase in the money supply. The money multiplier depends on the reserve requirements set by central banks and the propensity of banks to let out excess reserves. A higher money multiplier indicates that a given increase in the monetary base will lead to a larger increase in the money supply through the lending and deposit creation process. Then next comes the reserve ratio. The reserve ratio is the percentage of deposits that commercial banks are required to hold as reserves rather than lending out. Lower reserve requirements allow banks to lend more of their deposits, thereby increasing money supply. That means if the banks would hold lower reserves, then they would be able to grant or lend more and more part of their savings as credit, which would eventually increase the money supply. Conversely, higher reserve requirements constrain the ability of banks to lend and thus limit the growth of money supply in the market. Now, let us move further to the next slide, that is nature of money supply. The nature of money supply says that it's a stock concept, while the term money supply might imply a flow of money over time, it is actually a stock concept. This means it represents the quantity of money available in the economy at a specific moment, rather than the rate at which money is being exchanged or used in the transactions. That means money supply is the flow of money over time. It is a stock concept because it represents the quantity of money available in the economy at a specific moment rather than the rate at which money is exchanged or used in the transaction. The next is the common measures which are included in the concept of money supply. It is M1, M2 and M3. We have already discussed M1, M2 and M3 when we were talking about the concept or the meaning of money supply. Here, I would be briefing you about M1, M2 and M3 again. M1, as I already told you and we had discussed, that M1 includes most liquid forms of money that can be immediately spendable. That means any asset that is too liquid in nature that can be spent anytime, including physical currency notes or coins or the demand deposits, are considered as M1. Then M2 has a broader concept or measure than M1 because M2 includes M1 as well as the saving deposits, money market mutual funds, and small time deposits. M2 reflects money that is less liquid than M1, but it can be converted into readily available cash or it can be used for spending. So, M1 is the most liquid form of money, while M2 can be converted into readily available cash or can be used for spending. M2 includes M1 as well as saving deposits and money markets mutual fund. Next is M3. M3 has a broader measure than M2 and M1 because M3 includes both M1 and M2 as well as large time deposits, institutional money market funds, and other large liquid assets. M3 provides a more comprehensive view of the total money supply, including larger and less liquid financial assets. I hope the concept of M1, M2 and M3 is clear. Now let us talk about the importance of money supply. The importance of money supply is already discussed while I was discussing about the definition or the basic concept of money supply. So let us briefly discuss again about the importance of money supply. Let us start with it. That is, central banks and monetary authorities use the money supply as a key tool in implementing monetary policy. That means money supply is a tool, a very, very important tool, which is important in implementing monetary policy. Because monetary policies are directly influenced by the availability of money and credit in the economy. Central banks can regulate economic activities, control inflation, and stabilize financial markets. Then, money supply is also considered as an important indicator for economic activities. Changes in the money supply can indicate shifts in the economic activity and consumer spending. For example, if the supply of money is low, the economic activity or consumer spending would also become low and vice versa. An increase in the money supply may stimulate economic growth by boosting spending and investment, while a decrease might signal a tightening of credit conditions and potential economic slowdown. The money supply is closely monitored for its impact on inflation. That means money supply is also important during inflationary pressures because it closely monitored its impact. Excessive growth in the money supply relative to the growth of goods and services in the economy can lead to inflationary pressures as more and more money chases a relative stable or limited supply of goods and services. Now, let us discuss about the various factors which influence money supply. But before that, I would say that I hope I was clear in explaining the importance as well as the concept of money supply. So, there are various factors which influence the money supply. Let me tell you the first four factors, and then I would be discussing about the next four and then next three, because there are a total of 11 factors which influence the money supply. So the first four factors are monetary base, money multiplier, reserve ratio, and currency ratio. I'll be explaining these four, and then we'll be telling you the next four, and then we'll be explaining you those next four, and then briefing you about the next three, and then studying about the detail. So let us start with monetary base. The monetary base, also known as high-powered money base or narrow money, refers to the total amount of currency, that is notes and coins, in circulation plus the reserves that commercial banks hold in their account at the central bank. That means the monetary base is called high-powered money or narrow money, which refers to the total amount of currency, notes or coins in circulation, and also includes the reserves that commercial banks hold in their bank accounts at the central level. The monetary base serves as the foundation for the money supply because it directly affects the ability of commercial banks to create new money through lending and investment. Changes made in the monetary base controlled by central bank through open market operations and reserve requirements have a multiplier effect on the broader money supply. So, monetary base is also known as high-powered money or narrow money, which includes total amount of currency, notes or coins in circulation, plus the reserves held by the commercial banks in their accounts at the central bank. I hope I am clear with the monetary base, which influence the money supply. Then the next thing that influences the money supply is money multiplier. Money multiplier is a concept that reflects the ratio of the increase in money supply to the increase in the monetary base. That means the ratio of the increase in money supply to the increase in monetary base. It represents the extent to which an initial deposit can lead to a greater final increase in the money supply. That is, it represents an extent to which an initial deposit can lead to a greater final increase in the money supply. The money multiplier depends on the reserve requirements set by the central banks and the propensity of banks to lend out excess reserves. A higher money multiplier indicates that a given increase in the monetary base will lead to a large increase or a larger increase in the money supply through the lending and deposit creation processes. I hope the concept of money multiplier is clear. That is the ratio of increase in the money supply to the increase in the monetary base. Then next is reserve ratio. The reserve ratio is the ratio or the percentage of deposits that commercial banks are required to hold as reserves rather than lending out. It is often said that commercial banks have to have a minimum percentage of their deposits be ready in the form of cash. That means the minimum amount which these commercial banks are asked to hold as a part of their deposits is termed as reserve ratio. The reserve ratio is set up by the central bank, as in our country, as in case of our country India, the reserve ratio is 15%, which is set by the Reserve Bank of India. Lower reserve requirements allow banks to lend more of their deposits, thereby increasing the money supply. That means if the money supply needs to be increased, the lower reserve requirements should be low so that the banks could lend more of their deposits. Higher reserve requirements constrain the ability of banks to lend and thus limit the growth of money supply. I hope the concept of reserve ratio is clear. Now, the fourth one, as we had discussed, is the currency ratio. The currency ratio represents the proportion of money held by the public in the form of currency, that is physical cash, and relative to the deposits held in the banks. That means the currency ratio represents the portion or the proportion of money held by the public in the form of currency relative to the deposits held in banks. A higher currency ratio means that the country or the more money is held outside the banking system, reducing the amount of deposits available for banks to lend and potentially lowering the money supply. That means if there is a higher currency ratio, the amounts or the deposits with the banks would be lower and could potentially decrease the money supply. Conversely, a lower currency ratio increases the effectiveness of monetary policy because it would make the money supply at its maximum. That means lower currency rate would get the increase in the money supply, while higher currency ratio can be reduced if the money supply is low. Then the next four concepts that we are going to discuss is time deposit ratio, confidence deposit ratio, value of money, and real income. So let us discuss confidence in bank money. Confidence in bank money is the trust and the belief that deposits held in the banks are safe and can be easily assessed or accessed anytime. That means the factor that influence money supply is confidence in bank money. Confidence in bank money is the trust and the belief that deposits held in the banks can be easily accessed and nobody can deny the money they have deposited in the bank. That means the demand deposits can be availed anytime. High confidence encourages individuals and businesses to hold deposits rather than physical cash. That means if I would trust a bank and I would have high confidence, that means I am encouraged to deposit this money in the bank rather than keeping physical cash alongside me. It would increase the effectiveness of monetary policy in influencing money supply. Conversely, a lack of confidence can lead to bank runs and withdrawals, reducing the money supply as banks may need to sell assets or call in loans to meet the withdrawal. I hope the concept of confidence in banks is clear. Now, next we are going to study is time deposit ratio. The time deposit ratio reflects the proportion of deposits held in time deposits like certificates of deposits or CDs relative to demand deposits. That means it deposits is tied for a specific period, reducing immediate availability of funds for lending and potentially decreasing the money supply. Lower ratio means more funds are available for immediate lending and can increase the money supply. Now, the next is value of money. The value of money refers to the purchasing power influenced by factors like inflation, economic stability, and public confidence. Stable or increasing purchase encourages holding money as a store of value, potentially increasing the demand for money and affecting the money supply dynamics. Conversely, a decline in purchasing power may reduce the demand for money and influence spending behavior, impacting the money supply. The next is real income. Real income refers to the income adjusted for inflation, representing the purchase power. That means higher real incomes generally increases consumption as well as savings, affecting the money supply through changes in deposit levels and spending patterns. Lower real income may reduce consumption and savings, influencing the effectiveness of monetary policy in managing the money supply. Then, ninth one says interest rate. The interest rate is the cost of borrowing money or the return on investments influenced by monetary policy and market forces. Lower interest rate encourage borrowing and spending, potentially increasing money supply because banks lend more. Higher interest rates may reduce borrowing as well as spending, affecting the growth of money supply. The second last point is monetary policy. Monetary policy refers to the actions taken by a central bank to influence the availability and cost of money and credit in an economy. Central banks use monetary policy tools such as open market operations, reserve requirements, and interest rate adjustments to directly control the money supply. Expansionary policies increase the money supply to stimulate economic activity, while contradictory policies reduce the money supply to control inflation. The last factor which influences the money supply is seasonal factors. Seasonal factors refer to fluctuation in economic activity. Consumption patterns and financial flows can occur predictability during fixed time of the year. Credit influencing the money supply dynamics. For example, increased consumer spending during holiday season may temporarily boost the demand for money and deposits in the bank, impacting lending and money supply. So to conclude, there are factors collectively determine the size and growth of money supply in an economy. Understanding their interplay is very important for policymakers and economists and businesses to anticipate economic trends, manage inflationary pressures, and ensure financial stable conditions in the economy. Now, I hope all these factors which influence the money supply are clear to you all. Moving on towards the next topic is Introduction to Liquidity Preference Theory. Let us first understand the concept of liquidity preference theory. The liquidity preference theory is developed by John Maynard Keynes. It focuses on how individuals and investors decide between holding money and holding other assets. Other assets may include bonds or stock. The theory posits that people have a preference for liquidity, which refers to the ease and the speed with which an asset can be converted into cash without significant loss of value. That means this theory focuses on the ease and speed by which an asset can be converted into cash without any significant loss of value. For example, if I would be able to convert my furniture into cash, I would lose a significant value. But if I would sell anything that would made up of any precious metal, there is no significant loss of value. I would be able to exchange it with the amount of cash without losing much. Or I would say that this would increase its value over the period of time. So, there is no significant loss of value. That means the liquidity preference theory developed by John Maynard Keynes focuses on how individuals and investors decide between holding money and holding other assets, which may include bonds or stocks. The theory says that people have a preference liquidity, which refers to the ease and speed with which an asset can be converted into cash without any significant loss of value. The preference for liquidity states the ease or the speed by which any asset can be converted into cash without any significant loss of value. There are three motives for holding money. The three motives for holding money include transactions motive, precautionary motive, and speculative motive. The transaction motive says that the need for money to conduct daily transactions and payments. That means transaction money includes the amount or the money which is to be held by any individual or businessman to conduct daily transactions and payments. The next is precautionary motive. Precautionary motive is holding money as a precaution against unexpected expenses or emergencies. That means it is the amount or the money which is held by any individual or businessman to prevent itself from any kind of loss or any unexpected or unforeseen circumstances that would occur, and to prevent or to protect himself or itself in the unfavorable conditions. So, precautionary motive is holding money against unexpected expenses or emergencies or any other unforeseen circumstances that would happen during unfavorable times. The next motive is speculative motive. Speculative motive means holding money to take advantage of expected changes in asset prices or market conditions. So, the three motives that we have studied are transaction motive, precautionary motive, and the third one is speculative motive. Now, moving on to the next theory, next part of the same theory actually, is the interest rate and money demand relationship. According to liquidity preference theory, there is an inverse relationship between the interest rate and the demand for money. That means the inverse relationship is always negative. That means when the interest rate is high, the opportunity cost for holding money is also high. Therefore, individuals and investors prefer to hold less money and more interest-bearing assets like bonds or securities. That means that there is an inverse relationship between interest rates and demand for money. When interest rates are high, the opportunity cost of holding money is high. When interest rates are low, the opportunity cost of holding money is also low. Therefore, individuals and investors prefer to hold less money and more interest-bearing assets like bonds or other securities. When the interest rates are low, the opportunity cost of holding money is also low. When the interest rates are high, the opportunity cost of holding money is also high. Hence, there is less incentive while there are low interest rates on the interest bearing assets, and people are willing to hold more money. So, during high rates of interest, individuals and investors prefer to hold less money and more interest-bearing assets. But while there are low rates of interest, there is less incentive to hold interest-bearing assets and people are willing to hold more money. So, the liquidity preference theory says that there is an inverse relationship between the interest rate and demand for money. Next comes the equilibrium interest rate. The equilibrium interest rate in the market is determined by the intersection of supply of money. Supply of money is controlled by the central bank. The central bank of our country is the Reserve Bank of India. That means the supply of money in our country, India, is controlled by the Reserve Bank of India and the total demand for money curve. Let us understand this again. The equilibrium interest rate in the market is determined by the intersection of supply of money and the total demand for money curve. The supply of money is typically depicted as a vertical line because in short run, the central bank controls the quantity of money through its monetary policy tools like open market operations and reserve requirement and discount rates. So, the supply of money is typically depicted as a vertical line because in short run, the central banks control the quantity of money through its monetary policy tools, which may include open market operations, reserve requirements, and discount rates. The total demand for money curve sloped downwards from left to right, reflecting inverse relationship between interest rate and quantity of money demanded. So the question arises, why does the demand curve for money slopes downward from left to right? The answer to the question would be that the downward sloping curve reflects the inverse relationship between interest rate and the quantity of money demanded. So, the equilibrium interest rate in the market is determined by the intersection of supply of money and the total demand for money curve, which is the supply of money which is controlled by the central bank. The supply of money is typically depicted by a vertical line because central bank controls the quantity of money in short run through monetary policy tools like open market operations, discount rates, and reserve requirements. The total demand for money curve slope downwards from left to right, reflecting inverse relationship between interest rates and the quantity of money demanded. Moving further, the next is factors influencing liquidity preference is income levels. Higher income levels generally lead to a higher demand for money. That means if there are individuals and businesses earning higher, that means they would have a higher demand for money because individuals and businesses need more and more of money to conduct larger transactions and maintain liquidity. Second is expectations about future interest rates actually. Anticipation of future changes in interest rates can influence current demand for money. If people expect rates to rise in future, they may hold more money to take advantage of higher future returns in investments. That means changes to be done or to be made in the future interest rates can also influence current demand for money. That means if interest rates are expected to rise, people would take advantage by holding more of money and to take better returns on their investments. The third is financial stability and uncertainty. Economic uncertainty or financial instability may increase precautionary motives, leading to an increase in the demand for money as individuals hold more cash for safety reasons. I repeat, economic certainty or financial stability may increase precautionary motives, leading to an increase in the demand for money because individuals hold more cash for safety reasons. So, there are three factors which influence liquidity preference, that is, income levels, expectations about future interest rates, and financial stability and uncertainty. Higher income levels generally lead to higher demand for money, and lower income levels lead to lower demands of money because individuals and businesses need more and more of money to conduct larger transactions and maintain liquidity. Anticipating future changes in the interest influence current demand for money because if people are expecting higher rates of interest in the future, they may hold more money to take advantage of higher future returns on their investments. Then economic uncertainty and instability may increase precautionary measures, leading to an increase in the demand for money as individuals hold more and more cash for safety reasons. I hope I'm very clear with the factors that influence liquidity preference, income levels, expectations about future interest rates, and financial stability and uncertainty. Now let us move on to the practical implications of liquidity preference theory. Liquidity preference theory is applicable or implicated on monetary policy. It also influences investment behavior and also helps in economic analysis. Let us briefly discuss about these three practical implications of liquidity theory. First is the monetary policy. Central banks use the liquidity preference theory to guide their monetary policy decisions. That means the monetary policy decisions of central banks are totally influenced by the liquidity preference theory. By adjusting interest rates and managing the supply of money, central banks aim to stabilize economic growth, control inflation, and ensure financial stability. That means if the interest rates would be adjusted and managing the supply of money, central bank aims to stabilize economic growth, the inflation rate would also be controlled, and financial instability would be decreased, not completely removed. Second is investment behavior. Investors and financial institutions consider liquidity preference when making investment decisions. Changes in interest rates and expectations about future economic conditions can influence asset allocation, and investment strategies. That means investors and financial institutions do consider liquidity preference ratio when they make investment decisions. That means liquidity preference theory directly influence the investors and financial institutions while they make their investment decisions. Changes in the interest rates and expectations about future economic conditions can influence asset allocation and investment strategies. Then, the next implication is economic analysis. Analyze Economists analyze actually liquidity preferences to understand consumer behavior, forecast economic trends, and assess the effectiveness of monetary policies in achieving macroeconomic objectives. That is, economists use to analyze the consumer behavior and forecast economic trends by using liquidity preference theory and to assess the effectiveness of monetary policies in achieving macroeconomics objectives. I hope the practical implications are clear with you all. That is monetary policy, investment behavior, economic analysis. Moving further, let us discuss about the criticism and model applications of liquidity theory, that is liquidity preference theory. Critics argue that liquidity preference theory may oversimplify investors' behavior and ignore factors like risk preferences, regulatory changes, and global economic trends. The argument says that the investor's behavior is oversimplified and the factors like risk preferences, regulatory exchange, and global economic trends have been ignored. The modern applications of the theory of liquidity preference says, despite criticism, the theory remains a fundamental concept in macroeconomics and monetary policy. That means, despite of such criticism, liquidity preference theory is remain a fundamental concept in macroeconomics and monetary policy. It continues to inform discussions on interest rate dynamics and financial market behavior and economic stability. That means the critics' argument that the theory has oversimplified investors' behavior and the ignorance of facts like risk preferences, regulatory changes, and global economic trends. This liquidity theory still remains a fundamental concept in macroeconomics as well as in the monetary policy. It is still informing discussions on interest rate dynamics, financial market behavior, and economic stability. The conclusion of this theory says that the liquidity preference theory provides a framework or structure to understand how interest rates are determined. That means this theory is helpful in determining interest rates on the basis of individuals' and investors' preferences for liquidity. It also examines the transactional, precautionary, and speculative motives for holding money. That means by examining transactional, precautionary, and speculative motives for holding money, economists and policy makers can better manage monetary conditions. For instance, monetary conditions can be managed even better by the policymakers and economists by thoroughly examining transactional, precautionary, and speculative motives. The policymakers, by examining these motives, promote financial stability and support sustainable economic growth. That means this theory is also helpful in promoting financial stability and to stimulate economic growth. Understanding liquidity preferences is very essential for making informed decisions in financial markets and designing effective monetary policies. So, I hope criticism and modern applications of theory of liquidity is clear to you all. So, the theory of liquidity is over here. We'll be moving on towards the next topic, that is the mathematical equation for the supply of money. The mathematical equation for the money supply says that TD is equals to T plus P plus S. That means T, P and S, that is the total of transactional motives, precautionary motives and speculative motive is the total demand for money. Moving on towards the next topic is the limitations of liquidity preference theory. Let us study about the limitations of liquidity preference theory in detail. The first is assumption of constant employment rate. The first point of this theory or this assumption says critique. The liquidity preference theory assumes that the employment level or level of economic activity remains constant. That means the level of economic activity is always the same. It does not account for the fluctuations in employment that occur over different phases of the business cycle or due to structural changes in the economy. That is, the liquidity preference theory assumes the employment rate to be constant and not fluctuating in the rates of employment, or no fluctuations in the rate of employment over different phases of the business cycle or due to structural changes in the economy. The implication of the assumption says that employment levels directly influence individuals' income and spending patterns. That means the spending pattern is of an individual or its spending capacity is directly related or influenced by the employment level. During periods of economic expansion or contraction, changes in employment can significantly alter the demand for money. For instance, during economic downturns with rising unemployment, individuals may increase their precautionary savings, leading to a higher demand of money. Despite lower interest rate intends to stimulate spending. So, the employment level is a factor that influences individuals' income levels and spending patterns. During expansion or contraction of the economy, changes in the employment can alter the demand for money. The third we are taking is a real world example to understand the assumption of constant employment rate. In recession, even with low interest rates, households and businesses may prefer to hold on to cash rather than investing or spending due to uncertain job prospects and income stability. That means during the periods of recession, even when the interest rates are very low, households and businesses may prefer to hold on to cash rather than investing or spending due to uncertain job prospects or the income instability. The second assumption is assumption of fixed income level. The critique of the first assumption says that the theory assumes that individuals have a fixed income level. However, the incomes vary widely across different socio-economic groups, industries, and geographic regions. And they fluctuate over time due to economic factors like inflation, wage growth, and economic policies. So, the theory assumes a fixed income level, however, having a very widely different socio-economic groups, industries, and geographic regions, and the fluctuation over time due to economic factors like inflation, wage growth, and economic policies. The implication of assumption of fixed income level says that variation in income levels affects individuals' propensity to save or to spend. Higher incomes may lead to more aggressive investments in return interest bearing assets or return bearing assets, while lower income may necessitate higher precautionary savings. The theory's static view of income level limits its ability to account for changing consumer behavior and economic conditions. That means variations in economic levels affect individuals' propensity to save or to spend. Higher incomes may lead to higher interest-bearing investments, and lower income facilitates higher precautionary savings. Taking a real-world example to understand the assumption of fixed income levels is during periods of economic growth with rising incomes, individuals may shift their portfolios towards riskier investments, seeking higher returns. Contrary to liquidity preference theory's assumption of a static income level influencing conservative saving behavior. That means during the period of economic growth where the income was rising, individuals' portfolios shifted towards riskier investments, seeking higher returns, contrary to the theory of liquidity preference. Moving on further, let us discuss another limitation, that is binary choice between cash and bonds. The critique of this point says that the liquidity preference theory often simplifies the decision-making process as a choice between holding cash or investing in bonds. This binary perspective overlooks the diverse range of financial instruments available in modern markets, including stocks, mutual funds, derivatives, and alternative investments. That means the decision-making process is simple, a choice between holding cash or investing money in the bonds. The implication of this theory or this point, binary choice between cash and bonds, says that investors do consider various factors beyond liquidity when making investment decisions. There are various factors beyond liquidity that are risk tolerance, expected returns, time horizon, and portfolio diversification. I repeat, the various factors are risk tolerance, expected returns, time horizon, and portfolio diversification. The theory's oversimplification may not adequately capture the complexity of investment strategies and asset allocation practices in contemporary finance. So, investors consider factors beyond liquidity. They not only just consider liquidity as a factor before investing, but they consider other factors like risk tolerance, expected returns, time horizon, and portfolio diversification as well. Let us study this with a real world example. Investors may hold cash for liquidity needs, but also allocate funds to different asset classes based on their risk preferences and market outlook, adjusting their portfolios dynamically in response to changing economic conditions and investment opportunities. I hope this point is clear. Moving on further, the next limitation says that neglect of interest rate variability across markets. The critique of this says that the theory assumes a uniform interest rate across all financial markets. The theory assumes a uniform interest rate across all financial markets and investment instruments. In reality, interest rates vary across different types of bonds, like government, corporate, financial products like saving accounts, certificates of deposits, and geographic regions, domestic versus international markets as well. So, the theory of uniform interest rates across all financial markets and investment instruments says that there is a uniform interest rates, but in reality, the interest rates vary across different types of bonds. The implication of this point says that investors and financial institutions consider relative interest rate differentials when making investment important. Variations in interest rates influence capital flows, exchange rates, and global investment patterns, impacting asset prices and market dynamics. The theory oversight of interest rate variability limits its applicability in explaining cross-market interactions and international financial flows. Let us understand this better by choosing a real-world example, that is, central banks in different countries adjust interest rates independently to achieve domestic policy objectives, leading to divergent interest rates environment globally. This global interest rate dispersion affects capital allocation decisions and financial market correlations, which the liquidity preference theory does not fully address. So, let us conclude this topic of liquidity preferences theory. Understanding the limitations of liquidity preference theory is crucial for economists, policymakers, and investors seeking to grasp the complexities of monetary dynamics and financial markets. While the theory provides valuable insights into the relationship between interest rates and money demand, its static assumption about employment, income, investment choices, and interest rate uniformity constrain its ability to fully explain modern economic behavior and market behaviors. Acknowledging these limitations encourages the development of more comprehensive economic model and policy framework that makes better reflect real world complexities and dynamics. So, it is very, very important for the economists, policymakers, and investors to understand the limitations of liquidity preference theory in order to grasp the complexities of monetary dynamics and financial markets, because the theory provides valuable insights into the relationship between interest rates and money demand. Its static assumption about employment, income, investment choices, and interest rate uniformity constrain its ability to fully explain modern economic behaviors and market behaviors. By understanding these limitations, the development of more comprehensive economic model and policy framework that would better reflect real world complexities and dynamics would become easier.